Stop paying more in taxes than what is absolutely necessary. In this video, I'm going to be giving you 5 strategies that can help you pay less in taxes this year, because isn't that what we all want? And for some context, I have an accounting degree and I have my CPA certification, but I do want to add a disclaimer here that I'm not your CPA, and you should always consult with your own CPA to answer questions about your specific tax circumstances. And I also wanted to clarify that all 5 of these strategies I'm going to be giving you are fully legal, so no shady tax evasion strategies are in this video. And now that we've gotten that out of the way, let's get into the 5 tips that can help you save on your taxes. This first method is one of the easiest and most straightforward ways to reduce your taxes, and in my opinion, it's something that we all should consider taking advantage of, and this is contributing to your 401k investment account. So contributions to your 401k come out of your paycheck as a pre-tax deduction, which means that it automatically lowers your taxable income and immediately you will be paying less in taxes. I do want to specify that you're not completely off the hook on paying taxes on this account forever, because a 401k is a tax-deferred account, meaning that you're not paying taxes right now while you're contributing, but in the future, in retirement, when you start taking money out of the account, you will be taxed on those funds. And this is advantageous for most people because likely in the future you will be in a lower income tax bracket because you're not working. So you won't be taxed as much on those funds in the future as you would be if you were taking out the money right now. Moving on to the second strategy, which is to contribute to a health savings account, also known as an HSA, which in my opinion is one of the best investment accounts you can have. If you have a high deductible healthcare plan, you should strongly consider opening an HSA because they are triple tax advantage. And let me break down exactly what that means. First, the money that you contribute to your HSA is tax-free. So you can contribute to your HSA using pre-tax payroll deductions, which then automatically lowers your gross taxable income. Secondly, your money grows within the account tax-free. So all interest and earnings are not subject to taxes. And on top of that, you can invest the money you contribute to your HSA in index funds or ETFs and exponentially grow your earnings completely tax-free. And thirdly, you can deduct money from your HSA for qualified medical expenses completely tax-free. So these 3 characteristics make an HSA an incredibly powerful account. And also something that some people may not realize is that you can contribute to your HSA for the prior tax year up until tax day of the current year. So if you're watching this video prior to tax day and you haven't hit your HSA contribution limits, keep contributing because that can help lower your taxable income. On to the next strategy, which is charitable contributions. So donations that you make to qualified tax-exempt organizations are tax deductible. And these tend to be organizations such as churches or food banks, etc. So for example, if you have a habit of donating clothes or household items to places like Goodwill or Salvation Army, make sure you obtain a copy of your receipts so that you can keep track of your total donation amount. Typically, you will be able to deduct up to 60% of your adjusted gross income using charitable deductions, but that number could drop to as low as 20%, just depending on the types of organizations you've donated to. And one really important thing to note about charitable contributions is that you must be itemizing deductions in order for this to apply. So for those who don't know, you can either take the standard deduction, which reduces your taxable income by a fixed amount, or you can itemize deductions. That itemization is made up of various eligible expenses, one of which being charitable contributions. Since the goal here is to pay less taxes, you'll obviously want to choose whichever deduction is the greater amount. And overall, many taxpayers tend to claim the standard deduction, but this really just depends on your personal situation and the types of expenses you've had throughout the year. So in the case that you elect to itemize your deductions, you'll want to make sure that you have your receipts from your charitable contributions handy. Moving on to the next strategy, which is to deduct student loan interest. So federal student loans have been on pause since 2020, but private student loans have still been incurring interest. So if you have private student loans, you'll definitely want to pay attention to this. The student loan interest deduction is an above the line deduction, which just means it reduces your taxable income and saves you money right now. So you can deduct up to $2,500 of student loan interest paid. To be eligible for this deduction, your modified adjusted gross income, which is your adjusted gross income plus some exempt income, must be less than $85,000 if you're filing taxes as a single, and less than $175,000 if you're married filing jointly. And these are the very top income limits, so it's important to note that there are deduction phase-outs that occur prior to these limits. So the closer your income is to these top brackets, the less interest you'll be able to deduct. If you paid over $600 in interest for the year, then you will receive documentation on the total amount of interest that you have paid through the Form 1098E, which should come either through the mail or electronically from your loan service provider. The next tax reducing strategy is called tax loss harvesting. And with tax loss harvesting, you use your capital losses to offset your capital gains. More specifically, you could sell a security that is underperforming and then use that loss to reduce your capital gains. And if your losses are more than your gains, you can also reduce up to $3,000 of your ordinary income. And additionally, you can take your money from the sale of that underperforming security and reinvest it into a better performing option. I know that may sound confusing, so let me give you an example to illustrate what I mean. So let's say the investor, Sarah, has capital gains worth $2,000. And Sarah also last year bought stocks worth $15,000, which she sold for $10,000. So Sarah has a capital loss of $5,000. Using the tax loss harvesting strategy, Sarah could apply $2,000 of that $5,000 loss to offset her capital gain down to zero. And then she could use the remaining $3,000 of that loss to reduce her ordinary taxable income. And using this strategy, Sarah would save about $1,750, assuming that she has a 35% tax rate, because she would save $700 from not having to pay the capital gains tax and $1,050 from reducing her taxable income, which I think is a pretty good savings. Before you try this strategy, there are some important limitations that you should know about. Number one is that you cannot apply this strategy to all investment accounts. So if you're using an investment account that is tax deferred, like the 401k that we talked about earlier, then you cannot do loss deductions. And secondly, if you sell your security and then buy the same security or a security that is substantially the same within 30 days of that sale, tax loss is typically disallowed. So again, here you'll want to consult your own CPA for your specific circumstances to make sure that you can apply this strategy. Let me know in the comments below which one of these tax saving strategies you think you might be using this year. And if you enjoyed this video, give it a thumbs up and subscribe to my channel for tips on all things related to money. If you're looking for tips on money management, then click the video on the screen to hear about 12 money habits that you can implement this year that can completely transform your finances. Thanks for watching.